Well, the International Monetary Fund had warned earlier this month that the Iran war clouds the outlook for Asian economies, given that the region is the main buyer of oil and gas shipped through that strait. Asia's oil and gas use amounts to about 4% of its GDP, or nearly double that of Europe's share. The IMF says that the energy supply shock from the war is raising inflation in Asia and is weakening its external balances, leaving it with narrowing policy options. And for more, we are joined by Krishna Srinivasan. He's Director, Asian Pacific Department at the International Monetary Fund. Krishna, we appreciate you making the time to talk to us today. Sure. So I just want to follow up on some comments you made about 2 weeks ago. And you gave this reference scenario that assumed a conflict of limited scope and duration. And with that, you say that, the growth forecast for Asia broadly would be unchanged. But 2 weeks on, the ceasefire has been extended with no deadline in sight. The U.S. is continuing its blockade. I wonder how close we are to this adverse scenario that you've also painted.
So again, you're right. At the time of when we put out our forecast, we talked about a reference scenario. And there we said, if oil prices don't come down or they stay high for longer, you could be in one of these two scenarios, the adverse and the severe. And so the longer this thing takes, the higher the probability that you're going to go into one of these scenarios, adverse or severe. And what we indicated there is if countries go into that kind of a scenario, adverse or the severe, then growth could come down by 1 to 2 percentage points cumulatively by 2027, and inflation could go up by 1 percentage point in the adverse scenario and about 4 percentage points in the severe scenario, because that assumes that oil prices stay higher for longer. So the point I'm making is the longer this impasse continues, and you're going to slowly move away from the reference scenario to these other kind of scenarios.
Illustrate for us, when you say growth coming down by 1 to 2 percentage points, what could we actually see? Job cuts, how dire is the situation?
Again, as you know, that this is a very heterogeneous region. So we have countries which are largely oil importing, energy importing countries, and I've talked about those, where they rely a lot on energy intensity and they rely a lot on imports. So the 1 percentage point, we don't quantify that country by country because it's a scenario-based analysis. But I would surmise that the countries which import energy, which rely a lot on energy and import a lot of energy, will take a bigger hit. And that means that growth will decline that much more. And, personally, I would think that would translate into fewer jobs. Yeah. I know manufacturing would take a hit, industrial production would take a hit. And so in that sense, it would be a thing where not just growth, but other macro fundamentals are also affected.
Is there a realistic path for Asia to absorb some of these shocks without experiencing, these more dire effects like job losses, or at least trying to mitigate the number of jobs lost?
So countries, one thing we have to keep in mind is that this is not the first shock we're facing. We have faced a series of shocks for the last, I would say, 2 decades. And even recently, we had the COVID pandemic, then we had the war in Ukraine. So it's a series of shocks. What that means is that many countries have lost the policy buffers they had, whether it's fiscal, or I would say mostly fiscal buffers have been eroded. So in the context of this shock, if countries want to protect the vulnerable and so on, they have to provide targeted support to the people who need it most. And why do I say targeted? Because the fiscal envelope is as big as it is right now, and you want to keep some space. So if you want to protect jobs and so on, you also want to keep some powder dry to boost certain parts of the economy, which will create the kind of jobs. So you have to be very careful in using your buffers.
Yeah.
And that's why I talk about targeted support to the economy in the context of the shock.
Yeah, indeed. You did say that, broad fuel subsidies, for example, they're costly, they're regressive. But the cost of living crisis continues to plague many economies. And, we have seen uprisings, people are unhappy. So how feasible is it politically for governments to, and also from a social stability point of view then, to kind of avoid going for the subsidies kind of route, especially when people are feeling the pinch at the palms and in their wallets? This is something that is also about managing the perception of the people, right?
It's a great question. Here, the government is caught between a rock and a hard place. On the one hand, this is a big shock. It's affecting many countries, notably those which rely a lot on imports. At the same time, fiscal buffers over the years have eroded. So countries just don't have the kind of fiscal space to provide support to everyone. So that's why we're saying that those who need the help the most should get that. So make it targeted to people. I mean, we come from countries, both of us come from countries where not everyone needs a support, right? And assuming that this is a temporary shock, you have to protect those who need it the most, who are most affected. That's why we're saying keep your fiscal support in such a way that those who need it the most, whether it's a firm, a viable firm which is short of help, or people who are getting hit by the shock, keep it for them. And so that's where you have to be smart in not providing generalized subsidies and so on, because those are regressive, they're expensive, and once you give them, it's very hard to pull them back.
Yeah. And from what central banks can do, I think you also identified that different central banks are able to take different paths. So you also said that, central banks do have some room to kind of look through the first round rise in headline inflation, but you want monetary policy to be agile. So if exchange rates become more volatile because of the very different moves that central banks take, are you concerned then this could lead to very disorderly capital outflows, for example, especially for emerging Asia?
So in terms of your monetary policy, the first question there, Asia entered into this crisis in much stronger footing. Inflation was low, growth was resilient, and so on. And many countries, given that, many countries have the room to wait to see whether there are second-order effects from this energy shock. For instance, countries like Thailand, which have the growth is not that strong, they have a lot of slack in the economy, they can continue to wait to see if this shock leads to second-order effects or not. And if it doesn't, then they can cut much faster to help support the economy. There are other countries, such as Australia, where inflation has been above target for some time because of domestic demand conditions. They don't have the luxury to wait. They'll have to start tightening. And some have taken the risk mitigation approach by saying, yes, I do have some space. I could wait, but I want to make sure that inflation expectations don't get disanchored. So you have countries like Singapore and Philippines, which have tightened already. So I think it's important to, be data dependent, look to see how the shock is affecting your economy, and then take a call. Now, in terms of if there's exchange rate pass through, if exchange rates depreciate and that passes on to higher inflation, that also contributes to second order effects and so on. So that will be the time when you can see that there are the shock is affecting other things and having second round effects, and that's when you start being a lot more agile in terms of tightening monetary policy. So one has to be very much data dependent. It's easy to say be data dependent, but this is the time to actually look to see. If you look at inflation expectations in 2027, broadly speaking, they're still anchored. You see some incipient signs of movement in expectations, but so far it's been pretty anchored for 2027. But that could change if this shock continues for longer and if prices go up further.
And Krishna, if I could just squeeze in one more question. You also talked about the need for deeper regional integration. What does that look like in practice when the world's becoming more fragmented? And you have things like RCEP, for example. What is the role of RCEP here? What does it need to do? And also you have organizations like ASEAN. What can it do in this situation?
So not too long ago, we put out a report which showed that intra-Asian trade, intra-ASEAN trade, or trade within ASEAN is very limited. Trade within Asia is quite limited, especially when it comes to final products. So the point we were making is that in the context of repeated external shocks, one way to insulate yourself from these shocks is to trade more with each other. And don't forget, Asia has some very large markets, whether it's China, India, Indonesia. So if they start trading more amongst themselves, that itself is a buffer against external shocks. And we identified that if in the ASEAN context, if countries, they have reduced tariffs quite a bit, but if lots of non-tariff barriers are still there, if they all reduce their non-tariff barriers, there could be a significant impact on growth in these countries as a group, and notably for the ASEAN countries, which are open economies. So ASEAN will benefit a lot if it reduces its non-tariff barriers, and that provides an uptick to growth. So there is a huge room for an uptick in growth, which will also create jobs if countries start trading a lot more within the region. So intra-region trade within Asia, within ASEAN, within South Asia, there's significant potential there.
All right, Krishna, I really appreciate you coming in to talk to us about this. That's Krishna Srinivasan. He's Director, Asia and Pacific Department at the IMF.